Hi, I'm Alex, welcome to the channel and thanks for tuning in. So in this video we're talking about high tide again, and we're going to be covering an update on three important and very different things. Firstly, the debt deal and the elimination of the convertible debt and what this means for the company. Secondly, the upcoming results and what we can expect from them. And thirdly, we'll talk about something which I have been working on for some time now, which a number of members of our Patreon group have been really helpful in refining and pulling together. So if you're interested in high tide, then you definitely don't want to miss these. I always ask on this channel, please, in our battle against clickbait on YouTube, can you smash the like button? It's so helpful in letting the algorithm know that it doesn't have to only push clickbaity videos which aren't good for investing YouTube in the long run. You're doing an amazing job of this so far, it's really helping the channel and it's massively appreciated, so please keep it up. Thank you so much. If you're new to the channel, make sure you're subscribed. If you want to see more content, be involved in the private Discord and live video calls, then check out the Patreon. And as always, I'm not a financial advisor. This video is purely for educational and entertainment purposes only, but let's get straight into it. So firstly, let's talk about the announcement a couple of weeks ago in relation to the elimination of the convertible debt and what this means and why it is a significant step for the company. In summary, a convertible debt is basically a loan made to a company which will either be repaid by the company at maturity or in most cases converted into shares of that company. Now, most earlier stage growth companies which require funding will seek to finance the business with convertible debt. In the case of High Tide, the proceeds raised from this convertible debt instrument have been used to fund essential growth within the business, which in turn is a necessary step in helping the company deliver its strategy. The dilutionary impact from conversion of this instrument into shares has been known all along. Now, some investors have worried about this since the start, but this is not new news. It was always going to happen, so investors should not be thinking about it in this way and should not be surprised by this or thinking it's anything new. Most growth companies which cannot access the mainstream debt markets are funded with convertible debt. It's something that happens within most companies, it's not unusual and it's not shocking in any way. The important thing, however, is that this has now been eliminated from the capital structure. The instrument has been converted into equity and so it no longer exists on the balance sheet. Now, I've also had a load of emails from people being worried about more dilution here, and ultimately that is wrong. It's an old instrument, and all investors have known that this would be happening and this would likely convert into equity at some point. Now, this does also lead me quite nicely on something which a lot of people have been asking me for, and that's my high tide bear case. Now, I do have something which is coming on this soon. It's something which I give good consideration to in all of the investments I make, and I have mitigants against all of the main risks of that case. But keep your eyes peeled because that will be coming soon. Anyway, back to the elimination of the convertible debt and what's coming next. Now, the elimination of the convertible debt was a step that was required from the bank which is interested in lending to High Tide, and having access to bank debt like this is very positive for High Tide for several reasons. Firstly, debt is cheaper than equity, and I'll keep that in mind because I'll come back to that in more detail shortly. Secondly, having financing that's provided by a respected leading bank just brings greater credibility to High Tide, and that's something which will be paid attention to by a lot of professional investors. It also enables the company to have the firepower to do larger deals. That in turn means that the base shelf offering can be used for strategic acquisitions rather than other short-term cash needs, for example store opening expenses. So now going back to the point I made at the start about debt being cheaper than equity. Now you're probably asking, what on earth are you talking about? Okay, so very simply there are really just two ways you can finance a business, either through debt or through equity. Now the equity route is through issuing more shares and raising capital that way, and that is something which all investors in High Tide should be familiar with. Ultimately, that is how the business growth has been funded to date. Now the other way you can fund growth is through raising debt, raising money from a bank for a period of time and paying interest on this. Now digressing slightly, you have broadly two main types of debt instrument, bullet debt and amortizing debt. Now this is not exclusive here, but those are the two main types. Now bullet debt is where you say borrow $100 million for a bank, you pay interest on that debt, say 10%, and at the end of that period, say it's 7 years, you pay that full $100 million back in full, or you can refinance it, as typically is what happens. Now, amortizing debt is where you may borrow again, say $100 million, you pay interest on that debt, say 8% in this case, and you also pay back some of that debt each year. It's usually spread over an even time period, so if it's a $100 million loan over a 7-year period, that would be a repayment of the debt as well of around $40 million each year. So at the end of the term, you have no outstanding debt balance that's being fully repaid. Now, it's not as simple as saying one is better than the other. It ultimately all comes down to the cash flows that the business is generating, what sort of debt the business can support, and what instruments the lenders are prepared to lend. Now, I'm not super informed on the lending appetite for Canadian banks currently. I would assume that it would be something more of an amortizing instrument, but let's see. Now, if you're really eagle-eyed, you would have asked when I was going through those examples, why is the amortizing debt at a lower interest rate? Now typically this is because it can be considered a less risky instrument for the lender, so the rate of return they need to generate is lower. Each year some of the debt is repaid, so they don't have as much risk in that regard. Anyway, back to the point, why is debt cheaper than equity? What does that mean? Now it comes down to thinking about the financial statements and specifically the P&L or the profit and loss account. A company generates revenues, it has a cost of making those sales, and that leaves you with your gross profit. You then deduct all of your selling, general and admin expenses, your SG&A expenses, and that leaves you with your operating profit. From here you then include the impact of any interest income and interest expense, and then you have your profit before tax figure, which you then calculate the tax you owe on. Now when you have debt, you have a deduction of the interest expense you pay in the P&L, which ultimately means that your profit before tax is lower, and so you actually pay less tax. Now this is what you may have heard before as the tax shield. Additionally to this, the rate of return which equity investors require to be compensated for holding a stock, and in this case high tide, is also much higher than the interest rate which a company will pay on debt. Ultimately, in summary, I think this is great news. I see a lot of people saying that debt in companies is bad, and I disagree with that. Debt in companies is good if it's appropriately sized and managed. Too much debt or over-leveraging a company is bad news and that's not good, but appropriate levels of debt are good for companies and its shareholders. Now the next thing we want to discuss in this video is the upcoming company results. Now we know they're due to file on June 28th, and this will be when they file their Q2 earnings. This will be the first filings which includes the impact of the smoke cartel acquisition, which should help support strong growth on the Q2 period in 2020. Now before we go into what exactly I think, it's really important here to look at these results in light of how competitors have performed too. Clearly it would be great to see the company deliver strong growth and beat analyst estimates, but many competitors have missed their guidance. There have been a number of coronavirus lockdowns across many of High Tide's core regions, and a number of its direct competitors have missed quite significantly their result, primarily driven by these lockdowns and the impact that has on the ability for the business to generate revenues. In light of this, and having seen High Tide's competitors miss their estimates, I would be really pleased to see the company generate revenues in the mid 40 millions. If this can be delivered and the company could maintain adjusted EBITDA margins that it generated in Q1 21, that would equate to an EBITDA of around 5 million, which personally I think would be great news given the current operating environment. Now I do think there is a strong likelihood that this may be somewhat lower, but we will address this when we know the financials and we know the commentary that supports that. Clearly anything in excess of this I would see as a phenomenal performance, but I do caveat that I think this is probably somewhat less likely. Personally, I'm excited, but the financials alone are pointless without the management commentary to help us understand the exact dynamics underpinning those financials. Now the final thing which I'm keen to discuss in this video is something which I have been working on for a while now, and is something which a number of the patrons in our Patreon group have been super helpful in drafting and refining this too. I'm hoping that we'll be putting it up for approval by the end of this week, so however long that process takes from there is when it will be live. Once it is, I'll share a community post on YouTube with a link to the video, and it would be really helpful if you could take a read, share your thoughts, and if you like the article, share it more widely. Seeking Alpha has an amazing community of investors, and if the article gets good enough engagement, there is a possibility that they recommend it to other readers. This could be really helpful in pushing High Tide onto the radar of many investors who may not previously have heard of the company. As I said before, as soon as it's uploaded, I'll share a link, but all feedback and thoughts would be massively appreciated. Anyway, thank you so much for watching. I hope you enjoyed the video. If you did, please smash the like button. If you're new to the channel, then make sure you're subscribed. If you want to see more content, want to join the private Discord and the live video calls, then check out the Patreon. And as always, please let me know your thoughts and comments in the comment section below. I find it so interesting to hear all the different opinions and perspectives, so please get involved. Thank you so much for watching, and I'll see you in another video.